Hello, 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 and welcome to another episode of Market Bass. Gonna be a very interesting day today. Stock markets are waiting for the FOMC. Gonna be very interesting to see how the market reacts to this. We are expecting a 25 basis cut. Hopefully that maintains. Uh, I think I'm live. Yeah. Oof. Oof. Rates are set. Everything is laid out. Market is bouncing into the news. Could be seen as a sign of consent. Nvidia bouncing a little bit, the Nasdaq bouncing a little bit. Everything. Let's have a look real quick at what the market is. So we are 14 minutes away from the rate decision. Going to be an interesting day. We saw today small caps actually benefiting from the current environment. I am truly live. Hear me. That's not good. I am true. Oh, there we go. Oh, there we go. All right. Welcome to another episode of Mark. Yeah, it's gonna be an interesting day. Very, very interesting. Sure, FO meeting going live with 450 subscribers. So don't subscribe if you like the content watching. Don't forget to send me a message on the chat if you have any questions. Expecting the market to cave. Currently, we're expecting the market to sort of, I don't know, like Etoro expectations, at least in the poll that I did, was expecting a dovish cut of 25 basis points. I think the Fed watch tool, that's definitely priced in right now in markets. I don't think that changed drastically unless we see something major. Um, Probably. Yeah, 93%. Actually, I'm super surprised that we're still sitting at 6%. There is some hope we get a 50, but a 50 would mean that the economy is sort of recession, so we really don't. Oh man, good to be back. It's way too. It's way too. Oh man, right now, like I'm kind of bullish into this. I've no, like everything tells me that I shouldn't be, right? But I mean, like we are off all time highs. We did saw some. So market is acting healthy. It's definitely not a major move. Like the S&P 500 is 5% down.
We're now 10 minutes away from the top of the hour, where we see the release of the US interest rate decision. Forecast is for a 25 basis point cut to 4.25%. We also get the FOMC rate statement and the latest summary of economic projections. Quick note from SocGen ahead of this. They say the US labor market data has weakened significantly since the Fed's last meeting, with non farm payrolls nearly stalling over the past 4 months and preliminary benchmark revisions pointing to a record downward adjustment. They say the balance of risks has shifted sharply toward the labor side of the Fed's dual mandate, outweighing inflation concerns. Against this backdrop, SocGen expect a 50 basis point rate cut, which is a well out of consensus call, reflecting the need for forceful action after a prolonged period of moderately restrictive policy. Meanwhile, August retail sales likely rose modestly.
All right. So yeah, we saw some de-risking from big tech companies, but funny enough, a lot of it moved to the Russell, right? Interest rate cuts are interesting because interest rate sensitive companies that need to borrow money heavily, companies that benefit from having low access to capital benefit, and we saw that the IWM is actually up on the day. Market is setting up for a potential. I mean, like the expectation is that we're gonna get 4 cuts, and we probably don't get the 50 basis points. I think the market has priced that in already. But again, you could see a little bit of a freak. I mean, like say 8% chance, right? So we shall see. I don't think anybody's watching on Scots and Stocks. Probably the market bust is the. But copyrighted. That's the problem. Oh man. So expectations are 25 basis points and then a dovish rhetoric from Powell. We saw him in the last time he spoke kind of lean towards this, and we're giving sort of Trump the benefit of the doubt. The fact that Lisa Cook sort of got away with it maybe tells you a little bit. I don't think Powell does any like dealing, but well, Trump economy, everything's possible, right? So keep a close eye on it. Got 64 votes with 37.5% expecting a cut of 2.5% dovish cut. 25%. I'm actually surprised that this has the right. You go to the Fetch Watch tool, it's a 6% of a of a 50 point cut. And if we look at the probabilities here, we're also getting the summary of economic projections. SOP, right? We're getting the summary of economic projections. This was the last dot plot that we saw. I think this is going to shift down drastically by the end of the year. This gives us a lot of guidance because it's very close to the year. I think we're likely to be more something similar to this, right, where potentially we here. This is what I have. I actually did so. This is what I'm expecting. I'm actually expecting. So, I'm actually expecting.
So keep in mind, ahead of the rate decision, Societe Generale US rate strategist Rajappa says the Fed is going to have to front load rate cuts. Keep in mind in their analyst note, they said that they are expecting a out of consensus 50 basis point cut at this meeting. Brings us now 5 minutes away from the top of the hour, where again we do get the US interest rate decision forecast for a 25 basis point cut to 4.25%. We also get the FOMC rate statement and the latest summary of economic projections. A final note from Wells Fargo, they say the FOMC held rates steady at its July meeting for the fifth straight time, with dissents from Governors Waller and Bowman, who favored a cut, underscoring concerns about the labor market. They say inflation remains elevated, with tariff driven goods reflation and slower services disinflation, keeping core PCE above 1 percentage point, about 1 percentage point above target. Wells Fargo expect the Fed to resume easing this month, lowering the funds rate to 4 to 4.25%, consistent with earlier projections. Their forecast anticipates core PCE rising 3.1% on a Q4 to Q4 basis this year. They also note the labor market weakness has intensified since July, with payrolls growth averaging just 29K over the past 3 months and unemployment rising to 4.3%, the highest in this cycle. They say this backdrop has boosted support for cuts, including Powell. They expect the September SEP to turn more dovish, with median dots showing about 75 basis points of cuts this year and a lower
I don't think we
2026
get
rate path.
75 though. I think
Statement will likely
they're
acknowledge
gonna
weaker
give
labor
room.
conditions, but avoid committing to immediate follow on cuts, leaving flexibility for future moves.
So these are my predictions, right? And I don't know. I don't know.
Doc Jones Rajappa says the Fed has some luxury in spreading out cuts.
So we have the three, because the thing is like I also freaking printed, more printed stuff that I have, It's my liberation day today. There's no wind here. We have the hawkish and dovish. This is what I freaking. Let's see. I mean, like I could be wrong, 100%. Take this with a kilo of salt, but no financial advice. Trade at your own. I'm fully in. Like I think we're gonna see some weakness going forward, but I don't think we see it today. But I mean, we cut, But yeah, this is my expectations. This is what I think we're gonna do, and then potentially we see a bit lower, just because of the fears, right? The thing is, just like most of the data has come in pretty good, right? I just see that like there is some room to some of the peak. December, no. So yeah, we got Moran, right? So we got like somebody that's super like dovish. So that's one of the points that we get. So I'm changing my prediction. There we go. I am. Seems like I'm wrong. So 1, 2, 3, 4, 5, 6, 7, 8, 12, 13. You know what? One of the guys that left was Kugler, which was a little bit in the hot. So this is gonna be interesting. Hello, Dragons. How you doing? Yeah, me too, man. Me too. Like this one I'm worried about, right? Because like there's a lot of expectations. Markets are bouncing into the open, which is nice. But this is what my expectations are. My expectations are. I did the math, at least for this. You know what I mean? But the problem is like if we go here.
1 minute remaining. I'll lead with the US interest rate decision.
All right, because this guy, Demarios. Yes. All right. All right. We're going to get the 25 and then we're going to get the rhetoric. We're trying to get some information. Market's going to probably rally because they're going to take some important things away. If they mention unemployment, it'll be good. That'd be fantastic. But yeah. This is where I'm like, better than expected. Unemployment is better than expected. So that it doesn't make any sense to be here.
10 seconds.
All right. Ladies and gentlemen, welcome to another episode of Market Bass. All right.
Cut 25 basis points, cut 25 basis points, cuts to 4.25% as expected. Current year rate forecast at 3.625%, 3.625%. lower than the expected 3.875%.
Okay.
Next year's
They're
rate
going
forecast at
dovish. They're going dovish.
3.375% as expected.
Market's gonna
Over
like
the next
this.
2 years, 3.125% as expected. And over the next 3 years, 3.125% as expected. Long run at 3% as expected. So the Fed say downside risks to employment have risen. The median projections show 50 basis points more cuts in 2025. So again,
Yeah.
Fed median projections showing 50
They're
basis
giving
points
the benefit
more
of the doubt to
cuts
Trump.
this year. Cuts the target rate again to 4.25%, and says Governor Moran dissented in favor of a half-point cut.
Oh, wow. So he's super dovish.
So Fed officials' median view of the Fed funds rate at the end of 2027 at 3.1%. Median view of the Fed funds rate end of 2028 at 3.1%. Longer run seen at 3%. Again, the projections implying 50 basis points of cuts this year, 25 basis points of cuts in 2026, and 25 basis points of cuts in 2027. The
Ooh.
projections show that 9 of the 19 officials see 2 additional cuts this year, 2 see 1 cut, and 6 see no more reductions. Policymakers see a 4.5% unemployment rate at the end of this year, unchanged from the prior forecast.
It's lagging?
Again, the projections show one policymaker estimated the appropriate policy rate by the end of the year was 4.5%
Really?
unchanged, and one saw it at 3%. Policymakers see the end of this year's PCE inflation at 3%, unchanged from the June projections, foreseen at 3.1%, unchanged as well. So looking to the market, strength in the
How
S&P
is that?
500, weakness in the dollar coming through here following the release of this latest SEP.
All right, let me have a look at the summary of economic projections here real quick. Yeah. Yep.
The Fed policymakers in the SEP see 1.6% GDP growth this year versus 1.4% in June. And they see the longer run growth at 1.8% unchanged from the June projections.
So we're expecting unemployment to stay the same. We are expecting GDP to be actually better than expected, right? Inflation staying around 3% and core inflation staying at 3.1%. So we're not seeing any major changes. Wow. This is the new guy. That's not how I got it at all. Interesting. But then 2026, more cuts. So the average was here. Yeah, 3.75. Markets are liking this. I mean, if we go here, markets are liking this. For sure. Let me know, by the way, if the thing comes better.
Voice news disconnected.
Voice news connect. Let me have a look. Yep. Market likes this. Market likes this. Fixed position is gonna. I did a small little hedge. A small little hedge with everything. Yeah. Lucid. First solar up. Let's have a look. So yeah, market is liking this. We are 3 minutes into the release. And the stock market is benefiting. We are sitting major cuts. So the median projection shows 50 basis points. So one more cut. I don't know if that's. Fed projections imply additional 50 basis points. So we're cutting 25 basis points every single meeting until the end of the year. If everything continues to be as expected. 9 out of the 19 officials see. the Trump worker got upset. Oh, that's so good. I bought a couple of things and I exited a couple of. Microsoft down. I mean, interestingly enough, we're moving out of. But yeah, I didn't get this right. But look at that, right? Like this is the new guy. The new guy thinks that we should be by the end of the year. We should be by like 2.8, like 2.8 something. Kind of crazy. Kind of crazy. I see, my friend. That's like the. How is Mara doing? It's potentially up. Yeah, Mars up 1%, and Bitcoin up. Oh, Bitcoin's gonna. That's not bad. Let's have a look at the 5-minute. That's actually not crazy. Bitcoin didn't move at all. Let's read this out. Let's read this statement. Recent indicators suggest that the growth of economic activity moderated. The first half of the year, job gains have slowed and the unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated. The committee seeks to achieve maximum employment. Oh, 100%. Oh, 100%. Like, because it matters what he says, right? But, you know, like, you're starting to show the dissent in... It's funny that the one guy, you know what I mean? He's just guy. The Trump point. Let me actually go to Nick Timorio. This guy posts. I love the way that he posts because he gives you full clarity on what this is. So recent, although swings in net export continue to affect the data, they took that away, and it's like recent indicators suggest the growth of the economy. Unemployment has edged up, which wasn't there before. Job gains have slowed, and unemployment rate has edged up. That's dovish. That's very, very dovish. You know, it's very, very dovish here. The company seeks to achieve maximum employment and inflation, judges the downside risks to employment have risen. So this is important, right? So they're telling you right here that they're focusing on unemployment more than they're focusing on inflation right now. So there is scare that we could continue to see like continued hikes. But yeah, market is balanced. Oh, let's freak. I'm so good. I made a trade on nail today.
So the Russell 2000 rising 2% on track for its first record since 2021.
So the Russell, you see this? You see this? I talked about this. The Russell is green. Peace out. Oh, I should have bought something. Oh. Oh, wow. You know what it was? There were right trades, right? Like, I'm just like, I don't think tech right now is like, because like people are going to look that we're like, what we're seeing here, right? Like if you go to the S&P 500 rank, very clear. What you're seeing here is the winners, right? Like who are the winners? Tesla, Amazon, Meta, Google, Microsoft, the big seven. They're going to start diversifying into everything else. Home builders are going to take advantage of this for sure. For sure. Right? So
US 10-year yield falls back below 4%, near last week's low.
The 10 years under what? The yield? Yeah, it's crazy. Nvidia down, which makes perfect sense. Because Nvidia still has a lot of negative sentiment. Yeah, I do. But I mean, like, S&P should be up. You know? Upro's up. Yeah, you know what I bought today? I bought freaking 5x S&P 500. That's so low. AMD's down because Nvidia's down, right? And because of the China fears. Like if they're gonna stop American chips, they're gonna stop AMD as well, right? So yeah. Like I see a diversification of it. It wasn't much. It wasn't much, but I mean like it was good. It was a good trade. I'm also starting to like slowly re-enter my full position on Nvidia, right? Like I think 150 could like if we touch 150 is a great buy. You know what I mean? You heard it here first. Let's go here. Let's go to the day performance. Like look at this. The Russell is up 0.75%. Like even it's funny because like commodities are down and I don't understand why. And the VIX is down, which I get hurt on my trade. It's only like it's okay. Like I'm losing 150. Not too bad. He's gonna speak. This is gonna spike. We're gonna see some volatility, but he's gonna be dovish, man. Like I don't think he wants to be hawkish right now, right? He's done their job. Give him the Nobel. You know what would be hilarious if he gets the Nobel? If he gets the Nobel. Look at the Nasdaq. Look at the Nasdaq. Like all of the winners that have been winning Palantirs, all of those high growth names are gonna calm down for a little bit. We're gonna get back to reality a little bit. not even going to be a
US rate
lot.
futures pricing in a 94% chance of a cut in October following the Fed statement.
94% chance October.
Before.
Let's freaking
rate futures pricing in
go.
69 basis points of cuts this year following the Fed statement.
I need to
Little
figure out how to
changed in
watch the.
total.
I need to figure out how to get that date because I have no idea. It's like October. Bam. October. This just went to 90%. I'm assuming this went over. And that's assuming the data doesn't continue to get worse and worse, which is a very strong possibility. Avishka, welcome. I might miss your because your chat is there. The other chat is here. I could bring them.
Spot gold hitting a record high.
Gold is up. So gold is up. Interest rate sensitives are up. And I'm losing money. Okay. It happens. Just before, he'll dip, he'll talk, he'll dip even more, and then when he finishes talking, he'll be up. That's my idea. Like, this is good. This is good news. This is what the market was expecting. This takes a lot of risk off the table. Like, a lot of risk off the table. The next year was as expected. As expected. Like the thing, freaking the Trump puppet. Like there's a possibility to enter here. I think. Funny enough, again, the winners are gonna be, but like a lot of people are gonna start placing bets of interest rate sensitives, like home builders, RKT. Like, have you seen RKT? RKT, I called it. RKT. Look at. I just have Scotch and Stocks chat. Yeah. All right, I can read everybody. I can read everybody's. Yo, Baidu's nuts. You know, a friend of mine called it too. Because I bought Alibaba, right? I was like, look, Alibaba. I looked at the stock and it was beat up, all of that stuff. And then I saw Baidu, and I was like, Baidu kind of beat up, but I didn't know. Right? And he was like, man, Baidu is a great company, Baidu. And I'm like, I have no idea what they do. I didn't even look. But it was like crazy. I looked at Baidu today, and it's like Chinese companies are so beat up. Like, they're beat up to the pulp. It's like, even at current level, looks cheap. You know, obviously the numbers have to be true. That's the problem with China. But if the numbers are true, this is fantastic. Oh, I'm getting freaking rammed. Oh no, market turning on. Damn. Yeah, market's coming down. This be the thing is just like you have the fear of recession too here, and it's like a very fine balance, a very fine place. Is that my exit point? Yeah. Baba. Bam. All right, like that was just because of Chinese protectionism. RKT. Bam. Up. I called out 14. I called it here. Bam. Like Lucid, I entered Lucid the other day. Bam. Ooh, market's turning sour. Let's have a look. Look at a future. Oh. Down, the Dow down, Russell 2000 a bit down. Traders giving up on this. Market's dumping. The initial reaction was wrong. Okay, it is turning.
After the rate decision now, we're seeing gains in the US stocks reversing now. S&P 500 down spot 2%, Nasdaq down spot 7%. The Dow is up though, spot 8%.
Like there was nothing. Let's continue reading here. The balance of risks. The committee will continue. Not sure. Recession fears. Like it's the only thing I can think about is recession fears. But I mean, like I just think we're selling off before the tops. Ooh, market is turning sour today. That hurt. Oof. This was what the market was expecting. I wonder if it was priced in. Yeah. Maybe you wanted your buying opportunity. Maybe this could be it. Like I'm. Yeah. The Fed rate cuts and a narrow majority of officials penciled in a total of 3 cuts this year. Statement changes are dovish. Myron is the only dissent for 50 basis points. Makes sense. All right. Now we're going into the call. This tends to happen. You can expect it. Oh, look. Oh, such a good streamer. Come on, very good. Yeah. Don't forget to hit that like and subscribe. Power. Yeah. Gonna adjust. I wonder what Trump said. I hate the VIX. I hate the UVIX. I hate the UVIX. Why are you down? Let's have a look. Let's have a look. What did Trump say? Trump hasn't said. Walmart up, Costco up. Interesting. It's a very interesting move.
US 10-year yield falls below 3.99%, lowest since April.
Oh wow. The 10-year is down to 3.9, and that's why something I want to watch. Yield on the 10-year is 3.9%. Oh, that's so interesting. So we did see a massive drop. What happened to my Still up
We're in
pretty.
10 minutes time now. At the bottom of the hour, we get the
Okay.
FOMC press conference with Chairman Powell. We have posted the live video to this on the feed for those interested.
Like since August 15th, in a month time, we've seen it go down 0.2%. No, more. 0.35%. I wonder if people are now going into like the long end, expecting it to fall. Because we've seen credit defaults, like the what's it called? The junk bond credit spreads actually getting lower and lower. Massive whipsaw, right? Like in the Nasdaq, we definitely saw it, and the S&P 500, we saw it too. We got the 30-year mortgage today, and I wonder if that drops. Trying to compete. That would be. I'm 9 minutes before the call. All right. Market's recovering. Market's recovering. It was a buying opportunity right there. Market opportunity. I think the market just gave. I think big trader came in, try to get out of a bunch of positions. They're like, look, I don't want to take on the risk. Bam. Like there was massive volume that came in there. Funny enough, but we are getting it all the way back. I mean, this is not, like this is good. Funny, is the VIX moving? Oh, financial services are up. Great. Yeah, crypto's not moved at all. Like we had XRP like going into like alts, but nothing. Futures, I mean, the Russell is up, right? Currencies are up. 10-year up. The 30-year. I was looking at the 30. I saw something super interesting, which was that, like, the 30, if you make like a 1% change on the 30, like, such a crazy return.
Market data connection lost. Market data connection re-established.
Boom! Like, money's moving into the Russell. Like, I'm telling you right now, potentially what we saw was de-risking from the S&P 500 and the Nasdaq. Massive moves. If we go here, I was paying attention to this company right here. Like, I checked it out and then up for some reason. Yeah, S&P is gonna be up. I'm up. That's a 5% trade right there. Oh, I think when I bought it, we were down. I bought it the close of the UK. Then another one that did crazy, Lyft. I think Waymo's partnered with them for.
S&P 500 rebounds back in positive territory.
This treasury plan, I don't know. I don't trust it, dude. I don't trust it. I don't trust it. The compound people started talking about, no, but look at this. Bam. 1,700% up. Like, this is Hong Kong and China potentially getting access to Bitcoin and then Bitcoin, Ethereum, and Solana. I forget that the camera is there now. I keep thinking it's there.
And Powell beginning the presser.
Voice news disconnected.
Good afternoon. My colleagues in squarely dual mandate and employment rate low. Load same time. Support of our goal. Shift in so decide continue to reduce recent indicators. Degrowth GDP down from 2.4. Slowdown. Contrast, business investment, equipment, intangibles picked up. Activity. Summary of economic GDP. This year, 8%. In the labor, 3% will change here. Payroll. Good part of even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, this inflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
All right. That was more neutral than I expected.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
It's certainly possible. We're beginning to see, we have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say, if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. Typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timorosa, the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral. That's what we did today.
What circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
Follow up. every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame,
Market's
2%
down
inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is
0.25 cut.
Write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this
even the Russell gave it all back,
has been that inflation will move up this year, but that the basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market. And so we're moving in the direction of more neutral policy.
Are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Be meeting to meeting, data point by data point? Are we in the process of getting back to neutral?
So I think we're in a meeting by meeting situation. We're going to be looking at the data You know what? Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Damn. We're getting to my follow-up question, which is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Yeah, market's down. They don't like this at all. He's just saying he's data dependent.
You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do.
There was a chance to get out. There was a chance to get out.
And never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. People they're making their arguments, and we're having a great discussion around these challenging issues. So,
see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Like, he's super bro. Like, he's like.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions.
Yeah, it's ugly.
Down
Ugly.
911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate?
I'm surprised at the fact that the VIX is stable. It's not moving
data
at all.
that seems to be, as you've called it in the past, noisy.
So on the QCW,
and I'm surprised at the fact, like, look at the dollar. The dollar is going up,
it was amazing how close the expectation was. So, and the reason for that is for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. It's quite difficult to do, especially when the economy is undergoing big changes.
But
and they've
you're
been
likely
working
to
on
end the
that
day
and
red.
are making progress on it. But
We could see a
the
bounce
data
back,
we get
but-
is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret.
Coming back.
We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the
Why is
data
the
have
VIX not
sufficient
up, though?
resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say is, in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month or that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
For the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
It's true. Man, everybody's like, "Oh, we need to put them down."
Thanks.
I don't.
Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slides, like unemployment getting up 7%, declining
Market's
work
finding
rate,
a footing.
difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention you see minorities, unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all this together.
The volatility index.
To see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated investment.
We shut up and back down.
And, on the consumer spending side, higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were
there was a chance to get in
above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System, and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to always trying to do better.
Chairman, Neil Irwin with Axios.
There's
been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think
massive volatility.
My view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things, but yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. You go back 25 years, that was the typical thing, was that goods inflation goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it to retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing.
Fuck, I got this wrong.
All of those companies and
like this,
entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret?
It was a 10 for a trade and I missed it.
His speeches, for example, and then some of the forecasts that we see today. I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really.
PQQQ calls.
The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to
we are bouncing
make
drastically.
really strong arguments based on the
Somebody
data
big sold.
one's understanding of the economy. That's really all that matters.
So TQQQ.
That's how it's going to work, and I think that's
for sure, dude.
The institution that's in the DNA.
I've been having quite a lot of
That's not
success
gonna
with him. I'm not gonna lie.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the
economy. It was like 96 all the way to 98. That's a 2% move.
What's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything.
A 25% return on that trade.
That's what we're going to do. We're just going to keep doing our jobs.
But if you go, that's the TQQQs. But if you look at the options.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected.
I think 96.
It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dots are really so scattered between someone.
I wonder what ETH and all of them are
higher
doing
by
right
the
now.
end of the year to 5 cuts.
I mean, down.
What were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition. And
I'm planning to, and I'm planning to do it on Etoro too.
Per month, and many other things. I think that the new data that we've had, and it's not just payrolls, it's
you know what?
other things as well, suggests that there really is
you know
meaningful downside risk. I said there was
I can do that
downside
right
risk
now.
then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember though, the unemployment rate's 4.3%. The economy is growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times, but from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000,
my camera stopped working
a few months ago, it's come down quite significantly. That's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
By May, you mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong, strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does
coming down again.
Housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough enough housing for people. And all of the areas around metropolitan areas like Washington, for example, are very built up. And so you're having to build farther and farther out. And
It's getting
where it
better
is.
on Etoro.
And just a quick follow-up, during the last SUP or the press conference following the last SUP, you seemed to indicate that policymakers lacked conviction about their projections. And I'm wondering if you still feel that way.
Yeah. It's been crazy, yeah.
Forecasting is very difficult, even in placid
Get this
times.
file.
And as I've mentioned before,
We go to that 1 minute.
forecasters are a humble lot with much to be humble
A
about.
lot of people.
So I think right now is a particularly challenging time, even more uncertain than usual. And so
If we bounce, we
any
don't know.
forecaster anywhere, really, ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't
What a
think that
day.
has at all
What a day to be a
significant,
trader.
macroeconomic effects. These are pretty small numbers moving around inside a giant economy.
Like, look at this.
The level of runoff is not very large. So I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long interest rates. So
And it
what
hasn't
does
even been
Congress
that
mean by
bad.
moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finance? And do you expect today's cut will help?
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for.
Yeah.
And stable prices, so that should help.
This rate cut is coming at a time when the stock market is at or near all-time highs. Some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right?
Yes.
And our goals are maximum employment and price stability.
That's
and
it.
So we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. we don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run, they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations both break even in the markets, and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
That's it. GG's well played, ladies and gents. GG's well played. Summary time. Oh, it was a very interesting day. Extremely volatile, as we can see. Markets were all over the place. Big players were selling. Players were buying for sure. But we got the 0.25% cut to the Fed's fund rate, which is very, very good news. We are starting a cycle of slowing down. It was super. We called it. You know what I mean? Like, it was super interesting too because we called it, Dragos. I'm too panicky. I'm too panicky to be drinking whiskey right now. Ah, it's funny because I have the Scotch Stocks logo. I gotta make a market bus one too. But yeah, I mean, like, it was a very, very interesting. I mean, we see the volatility all over the place right here, right? It's just, we saw some weakness at the moment. You know what? I'll grab a beer. Interesting. What about the Coronita? Holy. But yeah, market seems to be finding a footing right now. Like, it's just the moment, you know what? This happened right here when he said data dependent. It was kind of crazy. He went data dependent, and the futures just like shot way down. Right? Go to the minutes. If we go to the nap, I'm gonna show it a little bit better. Right? Like, this was when he was like, hopefully we get a bounce. You know what I mean? I'm on a 5x, so it's, yeah. Oh. Take my hat. It was like we called it, which is the worst part. It was like we said this was gonna come down and bounce back up as he was talking, and we called it too, and we didn't trade it. I'm so sad. I'm so sad I didn't pull the trigger on those calls. Because let's do the TQQ right now is sitting up. Oh my god, that would have been a 50% trade right there. Cheers, might be cheers. I mean, it's a good day. It's a good day overall. Markets are gonna like this tomorrow. We could see some weakness tomorrow as this gets digested. But I mean, look, he didn't say much, right? He's like data dependent. We're gonna continue as long as we don't see anything. But they're leaning towards the fact that this is gonna get worse. So they're gonna have to get to somewhat neutral and then somewhat stimulating. Holy smokes. I'm down because Nvidia is down on the day because of the China news. Everything else sort of recovered. Except for free. I am super surprised. Look at this one. This one was a trade that I've been sort of playing. I don't know. I've been wrong about. Like this was data dependent, just bam. You know what I mean? The market didn't like it. So we are seeing, so if we go to the screen, the heat map, go to the Russell, we're still up. Oh, they. We don't condone leverage here. Oh. Bam. Bam. Oh. Pretty decent move. You're 25% up on that. Overnight feed. I mean, it's up to you. Oh man, I'm up because of First Solar. I'm up because of Lucid. I'm up because of Baba. Literally. You know something I saw yesterday? Market went down yesterday at night. I was paying attention and I saw the stock market. Oh my god. Goodbye, dude. Man, it just continues to pump. I don't get it. I don't get it. But it's so cheap. Like they're expecting this, but this. It's so cheap. Ah, but man, holding at 5x is market volatility. They did nothing for the longest time. Well, oh, wait, team. You bought more? I'm thinking, like market's pricing in. You see this? So this is why the market dumped. Because they were like, there is a possibility we don't actually get a continuous. Market's pricing it in. There is a chance in October we don't. Yeah, let's have a look. Coming up a little. I mean, yeah. EQQQs are back to even. The Nasdaq is up. I'm glad I went in. I went in on a couple of trades. I re-upped on my Nvidia trade. I think I don't know. Like I think this is like a little bit overblown. Like, I'm starting to go back. Take that into consideration. Man, friend of mine, Antonio, he called it. He was like, Baidu, dude, Baidu. And I have no idea. I haven't done the research on him. I don't know. Decided not to go. Man, anything you bought in that. Bam. There we go. Cloud. So, there's some news that I wanted to do a video. Ooh. You see, maybe this was why market, because 2026, 2027 cuts. Oh man. I'm still losing money today. Not so bad. It's not so bad. That number was a lot higher in just a couple of minutes. Wow. Man. I say. Oh man. You know what? I'm gonna leave the summary for the review. Leave. Oh, they too much of it. I think it was bullish, right? Because like they are signaling that they're gonna cut. They're just not telling you what they're planning to do for 2026. I just summary of economic projections sort of tells you what they're leaning towards, but I don't think it's a good point. Because if shit hits the fan, they're gonna be cutting, right? Well, so yeah, I agree. It's bullish neutral. I would say leaning a little bit more bullish just because hey, they're realizing that they have to do something. The unemployment fears are starting to creep in. That's okay. At some point, I was down a lot. But I have call options at 91. If I had bought some, so show you what. So a call option is buy 100 shares, certain price. Right now, certain price for me, I have a contract that right now, as of today, I could buy 100 shares of TQ91 and sell them market price. Right? Right? So we are at 91. right? So that one is sitting at 91. I can buy stock. Now, I paid for those goals. 355. That's my average. Right? So if we add 355 to that price, that's my break even. 94. Right? Right? So anything higher than that, I am in profit. Right? So when it went down, there was a chance of me to buy some more. I wasn't going to buy those. I wasn't going to buy those. But I could have bought some. Now, because it's up again, you're actually, I am making, if it's ruler and we start going up, we $4. Let's say it goes to 99. Bam. $5 points. I would make $500. No. $500 per copy. So if I spend 350, 500, my return is 100 and something percent. Option. Profit. Super stable. Find some good news before market open tomorrow. Go back to 0. That is okay. I'm up today. No. I should be. I'm flat today. A flat day. I traded. Like I'm flat in my other portfolio. Oh, my friend. I have no idea of the stuff. Tell you. I have been chilling, dude. I have been chilling. I went on a holiday for like a day. Farm, I have no idea. I have no idea. Whatever, I can't tell you anything. Gone up. It's retracing back. Probably some pharma news. Probably got some approval or something. Just like profit taking, probably. I don't know. I wouldn't know. I wouldn't know. Exactly. You know? Exactly. It's not financial advice. And you know who would be good to ask? But my sister hasn't paid attention to. I would have thrown at her. Well, I burned with it. You know what I mean? I lived through it. But we are okay. We are alive and well. I am. Massive move. Oh man. Yeah, I would have to look, Camille. I would have to look and do research on this. Because it's hard to say. The thing is with pharmaceuticals, like the reason they move so crazily is because I don't know. Like, it's like usually it's like a 50-50, 70-40. Like if you know anything about like approvals and all that stuff, you can sort of make predictions, but it's difficult. It's hard. It's hard. What a day. Like it's been what? 2 hours? Oh. What a day. What a day. What a day. Couldn't do anything today. Like my thoughts were on this the whole day. And funny enough, my predictions were sort of wrong. What did I? So this was mine. This was mine. They actually went 1, 2, 3, 4, 5, 6. Then one that we got section 8. That's what we. Most of them were here. So I think here I was expecting a low. Did get that crazy dot. I wasn't expecting that much. This point was here. The 2 points were. A couple more points were. 4 point. One person. I didn't do bad. For my first prediction, like on record, thank you, thank you, thank you. My price is I didn't lose a ton of money. That's okay. I'll take that. Which these are here for you guys being here. I have a feel this company is gonna bounce. Have a look at that company. Do your own research on it. Don't take this as financial advice, but I have a feeling. Then someone I made still up on the day. RKT. Short float sweet. Feels so high. Positive, positive, positive. There should be. All right. I'm gonna step away, guys. Thanks so much for watching. All that commit Dragos. See you guys tomorrow for the live stream. We're gonna do our regular stream. We're gonna be talking about the results of this, what our expectations are. Market selling off a little bit. Nothing to worry about. Thanks so much for watching, guys. Peace out. There's 4 people. Hooray.